Welcome back. Episode 119. With me today, we've got TJ, Keith, and Lisa.
Yeah.
Welcome back, Lisa.
Thank you.
Lisa's back.
I missed you
2 week
guys.
hiatus.
Yep.
How was the trip?
Yeah.
Give us a recap.
It was, there's not much of a recap. It was good seeing family and friends. It was
Where did
busy,
you go?
though. Austria.
Oh, okay. Just
So,
in
yeah.
case you're tuning in for the first time.
Yeah, right.
What was the highlight of the trip?
I guess I did a little girls trip with my mom and my grandma into the mountains of Austria, which is obviously beautiful.
Wow.
So seeing that again and having a couple of days with them alone, that was quality time. Other than that, I'm traveled throughout Austria to see everyone, catch up with everyone. So it was busy but good. But after 2 weeks, it's good to be back, to not live out of a suitcase, to have your stuff back.
I heard it was warm.
It was. So they're having the second heat wave, or I think the second or third heat wave this year. It was hot, and Europe is not very well equipped with AC. So it was
Tyler,
yes.
no good for you.
Nope.
Yeah. So happy to be back.
So that's
in
why your
AC and
thermostat
with
is
ice
set at
cubes.
75.
Hmm?
So that's why your thermostat is always set at 75.
Yeah, to get trained for summer vacation.
Well, that's good. Glad you had a good time.
Yeah, good to be back.
We'll jump into two truths and a lie. We're gonna do some U.S. debt type stuff,
Ooh, that's
especially because there's some news today with the U.S. Treasury
I did see that.
doing some buybacks on the long end of the curve to try to tame it a bit. So we'll see how that goes. But as of August 2026, total gross U.S. national debt sits at roughly $40 trillion with a T. B, Japan holds more U.S. treasuries than China and Mexico combined. The U.S. debt is expected to grow about $7 to $8 billion per day. Keith, I'm going to start with you.
Oh, you saw me looking down, looking away.
Keith looked away. Tried to avoid.
We'll do the best that we can here with a kind of process elimination, I hope. August 26th, the national debt sits around 40 trillion. Yeah, that was like 38, 39, but who knows? You give or take a couple months, you're probably at 40 trillion. That's what I'm saying. I'm debating on that one, but I'm thinking that's probably true. Japan holds more U.S. treasuries than China and Mexico combined. Surprisingly, I think that is true. So then that leaves me with C, which is the U.S. debt expected to grow to 7 to 8 billion a day times 3 is B. That's 2 trillion maybe a year. Yeah. I'm gonna say I don't think we're quite at 40 trillion, so I'm saying A is false.
Okay.
That was my
TJ?
wild stab at it.
Yeah. So looking through August 2026, debt at roughly 40 trillion. I think we are pretty close to 40 trillion now. How you define roughly is
That's where I think Tyler's trying to throw me in the weeds.
is up in there, but I'm pretty sure it's pretty close to that. Japan holds more. I know Japan is the largest holder in China. I don't believe Mexico is a big. Well, big. How do you define that? But it's not as big as Mexico. I'm going to say that is true as well. U.S. debt expected to grow 7 to 8 billion a day. That seems just a little bit high. I'm gonna go with C as the lie. A and B are truths.
Same thing as TJ here.
You're not going to go B just to cover the bases here?
No, I'm not. So I think we are close to 40 trillion or even slightly past that already. And with the roughly in there, I think we're good to go that this is close enough so it passes as true. Then I know Japan is the largest holders of U.S. Treasury. Mexico, I believe, is also not that large. China is larger, yes, but nowhere near Japan. So I believe that is true as well. That leaves me with C. I mean, $7 to $8 billion a day to new debt. I mean, that number alone is is crazy.
Silly, but it's either right on or it's fairly close. So
So I think yeah, by ruling it out, I think that is the lie. But if that number is too high or too low, it's still crazy. So C.
I've got all of you.
Oh,
Mm.
okay.
wow.
So Japan does hold about 11 trillion. China holds about 9. And Mexico holds about 6.
Oh, that surprised me.
okay.
I would discount. I would have gave Mexico 1.
But you have to remember who our biggest trading partners are.
Yeah.
China and Mexico. So
That
they
makes sense.
naturally they have to buy
Yeah,
a lot of U.S.
But I
debt.
still thought like Japan is larger than that. But yeah, okay.
Yeah.
So $7 to $8 billion a day to new debt.
Yeah,
We're
that's
at-
a
we're
couple
at-
trillion
This
a
is
year. Then, right?
eye-watering.
We're at 39.8 trillion. So that was the roughly 40. I rounded up.
See, I
figure
knew we weren't
it's-
at 40. That was my.
It's too big of a giveaway if you put 39.8.
Yeah,
Yeah.
Yeah.
that's fine.
That's right.
True.
I think everybody got
Um,
surprised about the Mexico. I guess that was
Yeah.
probably the
Yeah.
trick
Can
of
we
the-
choose something more upbeating for the next 2 tweets in a line? That's already like everyone is
You-
like,
well,
oh.
you're in charge next week, so you
Oh,
go
right,
right
it's
at,
me
right
again.
forward.
Anyways, so I know we've been talking just general earnings. It's been strong, but I want to talk more about markets and the fact that they've been surprisingly strong. I mean, we've got Iran-US conflict. You still have the tariff uncertainties that are in play. Like there's still stuff going on. There's elevated inflation. But Keith, you sent this chart over. We don't have it on screen, unfortunately, but you sent this chart over and it shows. So every day you can look at the New York Stock Exchange or the NASDAQ. The actual
Mhm.
volume of the stocks is the volume for
Up or
prices
down,
going
yeah.
up or down. And they
Yeah.
tell you how many stocks out of everything trading on the New York Stock
Exactly.
Exchange. But this year so far, we've not had one day where there's been more than 80% of the stocks having down volume, which is, I mean, just looking at the chart,
It's never
That-
happened in the last 30 years. So
and we still have time
a third
for
of
that.
third of the year.
But that would be a bad back half of the year. So I compare it to 2017 a little bit.
That's a good comparison.
So you've been in the business for a while.
hmm
So I'm curious your thoughts on just the current market, general environment, why you don't think these stocks are trading down.
Yeah, the reason I sent it is I was a little surprised that we haven't seen one day when you look at this chart that we're looking at had 30 years. And then to your point, I think 2017's kind of been the other that was right before you and I started here.
Mhm.
I was working at a different place and I remember it was just nonstop, steady every day.
30 basis points.
Yep. That's kind of how it felt like.
Yeah.
It was one of those where I think this year, surprisingly, I think has been a little more, seemed more volatile, especially
Mhm.
with the Iran situation where the market almost had a correction, almost down 10%. I don't remember in 2017. It must have been one of those periods as well, because in that year, I think there was 7 of days that had that 80% kind of
Yeah.
down volume day. Doesn't mean the stocks are cratered either, right? It could have been
Yeah.
one spread out, which I'm just surprised that we haven't seen one of those kind of days, especially with the Iran conflict. So it's just weird when you kind of take a step back and look at the history in different time periods that are kind of unique. You did a good job of pointing out 2017 was just that steady kind of grind higher. This year, as much as the S&P is up, 14-15% roughly. It's been a little more, I think, volatile, and I'm
Mhm.
just a little surprised we haven't seen more. But and I guess to your point, do you think we'll end that way? I probably not. I think we'll probably on this chart too. And the other thing we probably should discuss is probably an average. Looks like it's probably 10 to 15 days, maybe a little higher. And then
Yeah.
2022 had 30 some, 2020 or 20 when COVID hit 2020, that was actually only 31.
Which is
Which
kind of
again,
wild to think about.
I think those probably were all
Grouped
condensed.
together in the
That's why the
month
sell
and a
off.
half.
Yeah, right. So I think it's an interesting thing. That it's just, I guess the point being is, I would think we're going to kind of somewhat normalize, which means I think the markets will remain choppy, and I think we'll see some down days before year end. And that's kind of how I'm looking at things. As good as we are, and I think we'll be up before year end. I do think there's some maybe it's election driven, maybe it's more Iran. I don't
Yeah.
know. I think something's going to cause a few of these days to
Okay.
pop up.
So then, Lisa, let me ask you this. We've been getting a lot of questions lately Keith and I just did an investment insight series on all-time highs and strong markets. So we've been getting questions from clients on, do I hold back? Do I invest? Like when will markets pull back? Just what are the conversations you're having as those pop up?
I mean, that's always the question, right? Is it time for a pullback, or am I getting in now at new all-time highs? And I think that's, the questions of market timing, and that's usually a lost cause, right? And
Yeah.
when we look at the history, whenever you try to anticipate a pullback, it usually does not come, and then you have more good times ahead, and when it comes, you kind of make the decision at the wrong time, and then, okay, when are you getting back in, right?
Mhm.
Is it after 10% upside that you're tipping your toes back in, or vice versa? So that really works, and history shows again and again, staying in the market and staying invested, and even investing at new all-time highs might be positive in the long run, which seems counterintuitive as well.
Yeah. I'm going to jump around our notes a bit here because I want to ask this to TJ, because TJ was on the advisory side, if you will.
Yeah.
So how do those conversations go from the advisor perspective?
Yeah, there's with a lot of the clients and in increasing uncertainty and the volatility, they see a lot of the market movements at the headline level, and then obviously at the individual stock level as well too. But the thing I think to keep in mind is that you're investing, as Lisa said, you are investing for the long term. So keeping in mind that your investments are meant to help you over very long periods of time, and not trying to look at the next 3 months or 6 months. Now, entry points are important, but in the long run, if you look back 10, 15 years, you would barely be able to see that little blip on a long-term chart. So I think that's important to keep in mind, that longer term perspective. And I do think that as we come up to the midterms here, we typically do see a little bit increased volatility in flat to slightly down markets. But then after you get past the midterms, it usually moves higher. So that's sort of some tailwinds that we have, that we might see some choppiness going into the midterms here for the next 3 months or so, before ultimately moving higher. And moving higher is likely continued to be driven by the earnings.
So are you I'll ask all of you this, but I'll start with TJ.
Yeah.
Are you a lump sum investor, or are you a dollar cost average?
I would probably say I'm more on the dollar cost average side, but that hasn't prevented me from throwing in a little bit bigger lump sums. When the markets have those sharp drawbacks and pullbacks on there, you start to get a little bit more nervous that there could be some more downside in there. But at the same time, again, thinking about the very long term, and that some of these things are very short in nature, to throw a little bit bigger lump sum. But I'd say I'm much more on the incremental dollar cost average side. Yeah.
Keith?
I'm more of a lump sum guy. So usually when capital is available, then
It goes in.
It goes in. Yeah. I mean, I do have some that I sit on, small percentage that sits in my kind of a money market, kind of rainy day fund. So if there's like that time when you see that 10% correction, that's when I'll put that kind of allocation to it. And then once you're invested, and then, for my own trading account, you kind of have your core assets, just kind of like a client should have. And then you have some stuff that's a little bit more volatile, at least for me, that I can watch pretty closely. But for the most part, it's, stay the course, stay with your investment plan, listen to your advisor, stay diversified, and don't try to time the market. It's just hard. It really is. There's in 2002, again, dating my age is, the worst time period I think investing was that 2008, 2009. It was just awful. It was long. It was hard, and you put money in, and then 3 months later it was down. You put more money in, it was down, and not just my money, but clients' money. It was just a rough time period. So I think that period, you've been pretty rewarded for just if you have the assets, just to put them in the market and kind of set it and forget it. Put it according to your plan, right? I mean, if you're a 60-40, meaning you got 60% exposure in the market and 40, don't be going to 100% stocks just because you think it's a good time.
Lisa?
I would say I'm also a little mix of the two.
Okay.
I try to do it on a cost averaging basis, like on a monthly basis, no matter what happens. But I always try to have some lump sum on the side, and that needs to be accumulated as well.
Yep.
For things as TJ and Keith already said, if there's a sale going on, basically, and some corrections that I have something on the side that I can put into the market. So I try to balance the two out, and that's what I also often hear as a question is like, what is better of the two, right? Is it better to just put some lump sum in the market when you think the time is right, or is it just better to cost average and no matter what happens, you just put it in? And I think, I mean, it depends on also psychological factors, I think, because lump sum, you have to have conviction, and it's a much higher hurdle rate when you put that in, especially when markets are down, as opposed to just dollar cost averaging and not paying attention to it whatsoever. And for some people, that's just easier. They just don't pay attention to it and just same value every month or every couple of months, and that might be easier for some investors. So there's, I think, no right or wrong. It's just what works, so you actually put money into the market. I think that's the most important thing at the end of the day.
How about you?
I'm more of a lump sum.
Yeah.
When it's there,
it goes in.
We do get that question quite a bit from retirees, right? So that's the difference, right? As you go in your working, you're kind of doing that dollar cost averaging because you're probably putting monthly contributions in there, and then all of a sudden now you're no longer working. Say I've accumulated, and you find it more with people that have accumulated bigger asset base for some reason. That okay, now I may have, let's say, just picking a number, $3 million, and then it's like, okay, should I invest it all in this kind of plan, or should I put most of it in and then kind of over the next 6 months leg in, a couple different pieces? And to your point, there's no right or because we don't know what the market's going to do for the next 6 months, but as long as you do intend to get invested, over a shorter period of time. Because if you start dragging it out, then all of a sudden, like, your reference points is that first initial buy. And then if the market's up 20%, you're like, oh, I missed that, and I'm going to wait for it to pull back 20. And that's where you get into that trap.
And then you get into the
trap
circle,
of missing out.
Yeah.
So that I think you have to be careful on that.
Yeah, that's fair. So going back to the markets, though, so all-time highs, we've had 27 days this year. Last year, we had 39 trading days that hit all-time highs, and the year before that, we had 57. So all-time highs have to happen if you want your money to grow, right? It just...
It's the way it is.
The way it is. But you guys talked last week about earnings and strong markets, but there's an interesting chart that I saw where it showed with the 88% of companies having reported this quarter showing 50% year-over-year earnings growth, which is
insane,
unheard of.
Yeah.
So the question to you guys, and anybody can jump in, is how long do you think this can actually go on for?
Well, I'll start it out. Well, I think that this last quarter, the second quarter, will be the peak earnings growth as far as the earnings growth rate goes. But I think the key question here is how, and so meaning that the rate will decelerate. But I think the key question is how fast it will decelerate from, if this is truly the peak, which I think it will be. But yeah, we saw 50% year-over-year growth. A lot of that is driven by one-time, not necessarily one-time, but unrealized gains. And as we have in this chart here called the paper gains on there, that was because of Google and Amazon owning stakes in SpaceX and Anthropic. And then when they got marked up, they show big net unrealized gains on their income statement and on their earnings report. But the thing is that we are seeing a lot of other companies continue to grow valuations within the private market. So maybe these other income unrealized gains won't be as large as they were this quarter. I still think that there will be some of that as we continue to move forward. Anthropic going to be IPOing here soon. OpenAI likely next year, as their second quarter was a little bit underwhelming relative to Anthropic. But yeah, I think that's the key question, is just how fast do we decelerate, and do we land the plane basically, or does it go down straight down and crash? So,
Keith?
Crash. Wow.
Yeah.
TJ, we can't be using those.
It's a forbidden word.
Yeah, I think we're closer to as good as it gets for earnings growth rates. TJ kind of summed it up well. Of if we just decelerate, how quickly does that is? And like this year, the forecast is we started the year at about I think it was 18-19% growth for the full year of earnings for the S&P 500. Now with all Q1 and Q2 kind of done and how strong Q2 was, now the numbers are up over 25%,
which is crazy.
which is that's usually numbers you'd see coming out of a recession,
Yeah.
right? Where you had depressed kind of going into it, and then you see a snapback. That hasn't been the case, right? We've all known the last 3 years have been really good. So that's weird. And then next year, the forecast, it's a little early, but again, people put not our numbers, but I think consensus around 16-17% which is still a big
Even
number.
higher, yeah.
That's
not
a big
higher,
number, but yeah, it's not higher, but it's like
but it's still like way above
average.
long-term
I would say
Long-term
7 to
average,
8% long-term average. So you're double still that
Yeah.
versus triple this, you're double. And then we always say stocks follow earnings, and I believe they do. The question, I guess, from the stock perspective, I'm a little, as much as I think we finish up from here, another, I don't know, a few handful percent, whatever it is. I'm a little nervous that we're starting to steal some performance from next year, and next year, if something kind of could disappoint, that you kind of more have that normalized years to a subpar year, which at some point in time we're due after the markets were 26 and 25 and 17 and we're up 14 currently. So
Yeah.
So I'm keeping an eye on that. So I definitely want to see these earnings continue to follow through. And if they don't, I think that's where you could kind of see some kind of pullback.
Okay. Lisa?
I mean, yeah, to TJ and Keith's point, I mean, 50%, that's unheard of. And TJ alluded to it. There's a lot of, when it comes to earnings, a lot of paper gains and a lot of markups and all of that, and about unrealized gains in investments. These big boys like Google have, an Anthropic or SpaceX or something like that. But also, when and this is a point of discussion, right, with
Mhm.
accounting rules of what can be engineered and what flows into that. But I think when we look at revenue, which is that has to be earned, right?
Yep.
It's less likely to be engineered or anything shifted around, and that is above 15%. So 9 out of 11 sectors were able to grow revenue double digits,
Yeah,
which is the highest since
Yeah, that's a good point.
I think the fourth quarter in 2021.
Yeah.
So that is fantastic too. So while you can discuss one thing, revenue is more clear to see. Hey, this is really what it is, right? It's really a fantastic growth. I also believe, and when we look at the numbers of analysts, what they expect for quarter 3 and 4, that we have peak earnings growth and expectations now. The thing though is, with these high expectations, it gets harder and harder for companies to actually execute, right? And we saw that in this earnings season, that companies get punished very much if they miss earnings, and even sometimes if they beat earnings, right? And it's just like, okay, what are the whisper numbers, and are they actually beating those even unwritten numbers and even higher expectations? And I also what I think, and we talked about first, with a little bit higher volatility in the second half of the year, coming up with midterm election years that are usually more volatile, and some other things like Iran going on. I think the markets were able to look through all of that the last couple of weeks, specifically talking about earnings, and that was on the forefront of everything.
Yep.
Now that it's getting quieter there because we're in the last innings of earnings season, well, the market has more time or focus to shift back to other concerns out there, which is midterm election years, Iran, prolonged going on. So I think that can be a risk to higher volatility, that the market is finally focusing on something else again.
Yeah. So let's shift gears to concerns. So I threw 2 out here of mine that I'm looking at. One is the interest expense on our public debt, with interest rates going up so much, which means our outlays are about $1.3 trillion a year now.
Oof.
And obviously we heard today that Treasury is starting to,
What was the announcement this morning?
they're doing buyback operations on the long end of the curve.
Oh,
So they're basically
Interesting.
trying to control interest, or
rates.
controlling interest rates.
Yeah.
And now, I mean, it's good that the Federal Reserve isn't doing it, because I think that'd be a whole different story.
Mm-hmm.
But the markets are excited for that. So, or at least they're jumping this morning on that news.
Stay tuned.
So one thing I'd watch for is the interest expense, just because that number is going to continue to climb higher and eat up more and more of our budget. And the other one was the unemployment rate actually ticked down a bit to 4.1 in the last report. But the problem is the U.S. labor force is shrinking quite a bit, and we've basically round tripped the participation rate back to January of 2025, which means with different layoffs you're hearing about, people just are saying, I'm done. And so that's why your unemployment rate is staying steady, which I think is a big concern. The actual underlying employment labor market isn't all that strong. So curious what your guys' concerns are that could potentially start to derail this momentum that we have in the markets. Lisa, we'll start with you.
I mean, to this point here, and we saw some wild bonds things going on lately, right? With yields spiking up. And
Yep.
I think the market's actually, I mean, it was down the last couple of days reacting to that. But still not as bad as I thought. So kind of looking through that still. But I think as that might be going on, and that's worldwide, not only in the US. I mean, we have spiraling national debt, not only in the US. Then we also have more competition for US treasuries. I mean, thinking about all of these hyperscalers like Meta and Amazon and Google, just figuring out different ways to finance the AI build out, and a lot of them are issuing bonds now with attractive yields, and that's competition, right? That usually what usually would flow to US treasuries are now flowing to that. So that takes a little bit of that. Then also the Fed, I would say concerns, right? That still the market is trying to sniff out what Kevin Walsh is doing, or where the Fed is going, and what are they looking at, and what is important to them, and not knowing where interest rates are going. And we see that in the expectations for hikes or cuts or whatever are unchanged this year. So I think all of these uncertainties will at some point also flow into the market. And also, again, like higher yields is generally a headwind for stocks, right? And for
Yep.
gold prices, for example, because if you get higher yield somewhere else, well, some people might pull back a little risk and put it into the safer assets. So I think as this is going on, so today is obviously good news, but if that is still going on, and if there's still concerns about national debt, higher inflation because of the prolonged war and all of that, then I think it will finally also affect the market at some point.
Keith?
Yeah, I guess of the two, I'm probably a little more worried about interest rates over the short to medium term. The 10-year treasury hit 475, I think, the other day, and then which is the highest it's been in quite a few years.
Yep.
And then Lisa pointed out other countries are having the same issue. So you're seeing the cost of debt going up, which, again, if you have 40 trillion, that's a lot. So as your interest expense becomes a bigger part of your overall budget, then you get into the whole
Cuts got to come from somewhere.
cuts got to come somewhere, or they increase taxes, right? So then
Yeah.
that's a whole another political. We'll do a different show on that one. So that's so I do worry that interest rates expense as a whole is getting a bigger percentage of our overall budget. So that
Is
a
it not
concern.
always already higher than military spending?
It's right
I think
around there.
it's right around on
close.
pace, or
Yeah.
Which to think about that.
Yeah.
So normally it's it's quite a bit smaller.
Mhm.
So it's something to keep an eye on. Then labor force, so it's on that one's a little harder because you have participation, you got unemployment. There's different factors that you can see the health of it. I think the overall health of the labor force is generally pretty good. It's not as disrupted as some people would have said 6 months ago due to AI.
Yeah.
I do think there's jobs that are going to at risk, but I think there's other areas of increase. And then I think on your chart you had like 2.4 million decline in the labor force.
Yeah.
I don't know how much. The other thing is baby boomers, how many retire
Yep.
so over that period of time is what math is at. And so obviously I think immigration policies certainly have an impact. So all those things, I do think for the most part, most people that want a job are working or in a decent spot.
All right.
Yeah, I would probably say on the interest rate side, and another thing that can go into it too is if we did have persistent inflation, whether that's from starting to import more, or the remanufacturing that we're doing here. There's just a lot of inflationary forces. Obviously, the Iran war. So hikes on the front end. We have seen the yields drift higher on the top end. And Tyler, I'm glad you brought up that the liquidity support buyback program that they're doing, because we've seen yields drop meaningfully as soon as they announced that by 6 to 7 basis points on the 10 and 30. So very quick, meaningful move. You can tell that the administration and Scott Bessent are watching those numbers, and they probably got the levels that made them a little bit uncomfortable, and that's why they had done this liquidity buyback program there. But yeah, with our interest expense hitting 1.4 trillion, and I think the defense budget was 1 trillion, proposing to go to 1.5. I don't think it'll be like that. It'll probably sit about 1.2, but that's a big increase. And I just wanted to grab a quick stat on there. The average interest rate that we paid on our debt has increased significantly within the last 5-6 years. We went from about 2.4% pre-COVID to now averaging 3.4%. So it's a big increase on the average interest rate that we're paying on there. And just to touch on the labor force piece quick, that's unusual that you see a decline in the household employment and a decline in the unemployment. You would normally think that people are losing jobs, unemployment rate goes up. So I am just a little bit concerned that there might be some people that are unemployed that are just giving up looking for work because it's too difficult, or they've been looking for a long time. But the thing that kind of brings me back to the labor force remaining solid is the prime age labor force participation rate remains above pre-COVID levels and near all-time highs, although we have seen that tick down a little bit this year. So that's been the one thing that I've been watching on the labor force.
Sweet. So on that note, real quick, because we're running out of time, I want each of you to give me a speculative stock pick, one that you would just trade and you probably wouldn't hold for a long time. This is by no means a recommendation for anybody.
Wow.
I'll just disclose that right now.
Tyler,
and then I want you guys to give me like a traditional large cap name that you're probably going to invest in for the next 10 years and hold.
Oh boy, why don't you start with this one, since you delve in that space quite a bit more than the rest of us probably.
My speculative name lately has been El Monte Industries.
What is that?
They are a tungsten miner, ticker's ALM. But tungsten is becoming really big in 3 nanometer semiconductor chips.
Okay. Wow.
Because it's a good conductor of energy. So that's my speculative pick. And then
guess Broadcom.
I mean, I would say that, but I'm going to switch it up a bit.
What?
I'm going to say JP Morgan would be my
Come on.
go-to steady Eddie.
Oh boy, we got to cut this segment out.
I mean, I can say Broadcom if you want, because
No.
that'd be one too.
Broadcom mentioned.
Hey, Lisa, what do we got?
I misunderstood that a little bit.
Uh-oh.
So I thought, okay, one steady Yeti name for 10 years and then one highly speculative name that you think in 10 years is
No, not
whatever.
Yeah, you throw a couple names out people should be
I don't
looking
know.
at.
So I don't know. Western Digital is highly speculative. Already had a
Okay.
huge run. It's not a recommendation. I thought like for the next 10 years, it's kind of highly speculative because you don't know what's happening with
Yeah.
storage and all of that.
You going long or short that one?
Well, at the moment, it's like, and then steady Yeti for the next 10 years, I would say something like Amazon, Keith. Oh, Amazon,
No. Wow.
Walmart, Costco, or something like that.
Yeah.
All right.
For a highly speculative, Dicom would be another one. An AI
Yeah,
infrastructure build.
Lisa and I may have to come back next week with that one because I was kind of just going.
I kind of
different
misunderstood the speculative time
I
frame
want you
here
to
a
give
little
me
bit.
a very speculative
No,
stock.
I
and
didn't
give me
misread it.
one
I
that you would
didn't-
invest in for the
yeah.
next 10 years.
I didn't read it, but the amount you should. I mean, if you're going speculative, you should go look at Tyler. I think you recommend a few kind of like these biotech names.
Not recommending, Keith. We're not recommending.
not
on the
No,
podcast.
not recommend. What you and I have talked about in the
Yes.
past. Some biotech stocks.
Okay, then let's take for speculative. I take Dicom.
Okay.
Which one?
Dicom.
The DY.
DY.
That's interesting.
yeah.
All right. Yeah. I'll go next since I didn't really have anything for this either. Since I got busy and I don't delve in the small.
Okay.
I'll give you a one that's volatile. How
Throw
about
out
that?
Amazon for
So
the steady
no, I'm
Yeti.
gonna the one that's been CrowdStrike. I think that's just
Mm-hmm.
I like cybersecurity, so I guess
Yeah.
I'm gonna have a better answer for you next week. But
Okay.
I'll delve down into a smaller cap because I think
Yeah.
to be truly speculative,
That's what. Yeah.
that's I know what you meant, and then
Yeah.
I just kind of I kind of got busy, and then for a true long term compounder, I'm gonna have to. Lisa's got it going on. She's stealing my Amazon. I'm the Amazon guy, but I still like it. I think that's still a key because I like it because it's got both, not just all
Mhm.
technology, and it's got
Yeah.
retail. That's why I think that's a nice, solid name. Whereas if you go a pure technology name like Nvidia or something like that, you're really expecting it always to be technology. And
Yeah.
at some point in time, I think consumers. So again, I'm sticking with that one.
All right.
I'm,
TJ.
I'm gonna for the long term one. I'm gonna stay within the Make 7. I'm gonna go with Microsoft. I think that
Okay.
they got a very well diversified business. The Azure business is continuing to run and click on all cylinders. So I like Microsoft long term. And then my speculative one, I go with IonQ.
So there is someone
okay.
prepared.
They're
All right.
yeah, they develop and manufacture the quantum computers,
Oh,
and
that's not probably a bad. I like that
yeah.
call.
yeah, I think that that's something that's going to be, front and center in the next, I don't know how many years, but the technology is developing, but it's one of those that is speculative because no one really knows the exact timing of when everything's going to happen. So I'll
like
go
that.
with
TJ, way
the
to bring a good
quantum
idea.
one.
All right.
A good idea.
TJ
Lisa,
is the
Lisa,
only one
Lisa and I
prepared.
kind of fell down.
I misunderstood the task.
I even got these out
You did.
last night. All right. Well, we will see all of you guys next time. Like and subscribe.